There is a hidden pattern behind every major market collapse in the last 100 years. A pattern so consistent it almost looks like fate. Not a theory, not a prediction. A mechanical sequence that repeats with ruthless precision, and the wealthiest, most strategic investors in history have used it to make fortunes while everyone else loses everything. In 1929, 6 months before the market fell 89%, Joseph Kennedy quietly executed 3 trades. He converted his stocks into cash. He accumulated gold. And he positioned himself for a volatility explosion. When the crash came, while ordinary Americans were wiped out, Kennedy made the modern equivalent of hundreds of millions. In 1987, Tudor Jones made the exact same 3 moves: cash, gold, volatility. On October 19th, the single worst one-day decline in stock market history, Jones made $100 million in a single day. In 2008, Michael Burry, John Paulson, and a tiny group of contrarian thinkers repeated the same 3 trades: cash, gold, volatility. They didn't just survive the collapse. They printed billions. And now in 2025, Warren Buffett, Ray Dalio, and Bill Ackman are executing the very same 3 trades once again. Not 2 trades, not 5 trades, exactly 3. Why? Because all major crashes follow the same 5-stage mechanical sequence. Extreme valuations gives excessive leverage, gives a triggering event, gives forced liquidation, gives panic. You cannot stop this sequence. You can only position for it. And that's why the 3 trades exist. Trade 1 protects you from the collapse. Trade 2 preserves your purchasing power during the aftermath. Trade 3 profits from the crash itself. This pattern worked in 1929. It worked in 1987. It worked in 2008. And it is unfolding again, right now, in 2025. So before we break down the 3 trades, let me walk you through the historical timeline. Because once you understand how the pattern played out over the last century, you'll understand exactly where we are today, and how little time remains before the next collapse. The first move the smartest investors always make is deceptively simple. They get out. They reduce exposure, unwind positions quietly, and convert to cash long before the public has any idea a collapse is coming. And every major crash shows the same pattern. 1929. Joseph Kennedy exits before the spiral. The market had tripled in 5 years. Margin debt was extreme. Everyone was leveraged. But Kennedy understood the simple truth. When everyone is fully invested, there are no new buyers left. So throughout the summer of 1929, he sold slowly and quietly, moving mostly into cash by September. 7 weeks later, the market began its historic collapse. Kennedy was already out. 1987. Tudor Jones calls the crash early. By mid-1987, valuations were stretched, leverage was rising, and program trading created instability. Jones didn't just sense danger. He predicted October specifically. So he raised cash through August and September. The market peaked October 2nd. 17 days later, it fell 22.6% in one session. Jones was safely on the sidelines. 2008. Burry, Paulson, and Buffett. See the bubble first. Michael Burry began raising cash in 2005. John Paulson did the same in 2006. Buffett increased Berkshire's cash position from $40 billion to $60 billion by 2007. The message was clear. Everything is overpriced. The system is unstable. The market peaked in October 2007. The crash unfolded in 2008. The smart money had already exited. 2025, the most extreme cash position of all time. Warren Buffett now holds $325 billion in cash, the largest corporate cash position in U.S. history. He has cut his Apple position in half, reduced major bank holdings, stopped buying entirely. His 2024 letter said he cannot find anything attractively priced. That is Buffett's coded warning. Everything is far too expensive. Meanwhile, Bezos has sold $13 billion plus of Amazon. Zuckerberg has sold billions of Meta. Jamie Dimon sold stock for the first time in his career. Insider selling is at 2007 levels. The people closest to the numbers are exiting. Trade 1 is already happening. Trade 2. Gold accumulation 1 to 4 months before the crash. Cash protects you from falling asset prices. Gold protects you from what happens next. Currency devaluation. Every crisis is followed by massive money printing. That's why the same investors who raise cash also quietly accumulate gold. 1929 gives 1934. Baruch prepares for devaluation. Bernard Baruch moved into gold before the crash, knowing that governments always respond with currency manipulation. Gold stayed stable through the crash, then jumped 69% when FDR revalued it in 1934. 1987. Gold spikes during panic. Even though 1987 was a fast crash, gold still surged from $300 to $475, a sharp safety-driven spike. Jones held gold as a hedge, and it delivered exactly when fear peaked. 2008. Gold triples as the Fed prints trillions gold, climbed from $600 to $1,900 between 2007 and 2011. Paulson massively increased gold holdings after profiting from CDS trades, knowing the Fed's money-printing response would be enormous. 2025. The largest gold buying spree in modern history. This is unprecedented. In 2022, 2023, and 2024, central banks bought more than 3,000 tons of gold, the highest accumulation since records began. The biggest buyers: China, India, Russia, Turkey, Singapore. Why? Because they expect debt problems, dollar weakness, and global monetary restructuring. Gold at $2,450 is not speculation. It's a warning signal. Ray Dalio, Druckenmiller, and Tudor Jones all hold gold as core protection. Trade 2 is clearly underway. If Trade 1 protects your capital and Trade 2 preserves your purchasing power, Trade 3 is where the real money is made. This is the profit trade, the moment when the few investors who saw the crash coming flipped the entire collapse into a massive payday. And in every crash of the last century, the same instruments appear: short positions, put options, credit default swaps, VIX, calls. These are the tools that explode in value when fear hits its peak. Let's walk through exactly how each legendary investor used this trade. 1929. Kennedy shorts the collapse after moving to cash and accumulating gold. Joseph Kennedy positioned for the crash by shorting stocks, one of the few volatility tools available at the time. He paid borrowing costs while the market stayed euphoric. But when prices began to fall, the cascade was violent. 30% down in days, 50% down in weeks. Kennedy covered his shorts at the bottom and made an estimated $15 to $50 million, worth hundreds of millions today. Trade 3 delivered exactly what he was waiting for. 1987. Paul Tudor Jones executes the most famous volatility bet ever recorded. Jones's setup is legendary because it was caught on camera. He bought massive positions in index put options, instruments that increase in value when stock prices crash. He paid premiums for weeks while the market crept upward. Everyone else believed the rally would continue. Then October 19th arrived. The market fell 22.6% in one day, still the worst single-session decline in history. Jones's puts skyrocketed. His fund reportedly made $100 million that day and was up 62% for the month. It is the cleanest, most textbook example of Trade 3 ever documented. 2008. Burry and Paulson build the most profitable volatility trades in history. The instruments were more complex this time. but the principle was identical. Michael Burry knew he couldn't short subprime mortgages directly, so he worked with banks to create credit default swaps, insurance bets against mortgage bonds. He paid premiums for years. He lost money month after month. Investors demanded he stop. He refused. And when subprime defaults began in 2007, the entire structure collapsed. Those swaps paid out hundreds of millions. John Paulson executed the same strategy on a massive scale, tens of billions in notional exposure. When the bonds imploded, Paulson's funds made $20 billion, one of the greatest trades of all time. Trade 3 again. Same playbook, but scaled up. 2025. The volatility bets are already appearing. This is where the pattern becomes impossible to deny. Right now in 2025, the same instruments used in the previous crashes are lighting up. Credit default swaps on commercial real estate are spiking. Put option volume on major indices is unusually high. VIX call activity is elevated. Institutional investors are buying protection with 2025 to 2026 expirations. Why? Because commercial real estate is in crisis. Office buildings 40 to 50% vacant. Mortgage originated at 3% must now refinance at 7 to 8%. Billions in debt rolling over with no buyers. The math doesn't work. Defaults are guaranteed. And investors who understand 2008 know exactly what this means. Bill Ackman, who turned $27 million into $2.6 billion in March 2020, has publicly hinted he's hedging again. Even if he won't give the details, his tone is unmistakable. Trade 3 has begun. The volatility bets are being placed. The mechanics. Why the 3 trades always work. The reason these trades repeat isn't magic. It's mechanics. Every major crash follows the same 6-stage sequence. Extreme valuations, euphoria, and narrative-driven buying. Maximum leverage, a trigger event, forced liquidation, panic. This sequence hasn't changed in 100 years. The only difference is the technology used. And the 3 trades are specifically designed to match these 6 stages. Cash protects you from the forced liquidation phase. Gold protects you from the money printing that follows panic. Volatility bets profit directly from the panic itself. The sequence doesn't care about opinions. It doesn't care about politics. It doesn't care about optimism or hope. When valuations get extreme, when leverage gets excessive, when the trigger hits, the same avalanche begins. And the people who prepared with the 3 trades do not suffer the collapse. They profit from it. All evidence points to the late stage of the cycle. Trade 1 cash, already completed. Buffett sits on $325 billion. Insiders are selling at 2007 levels, and major executives are exiting near all-time highs. Trade 2 gold, active. Central banks have bought over 3,000 tons in 3 years, the largest accumulation ever recorded. Trade 3 volatility, underway. Credit default swaps on commercial real estate are spiking. Institutions are loading up on puts and VIX calls expiring in 2025 to 2026. When all 3 trades show up at once, the crash historically arrives 12 to 18 months later. That puts the window at late 2025 through 2026. Could it come sooner? Yes. Could it be delayed slightly? Possibly, but we are close. And when the collapse begins, the pattern will look familiar. S&P falling from approximately 6,600 toward 3,500. Commercial real estate defaults triggering bank failures. Unemployment doubling. Volatility exploding. That's when the 3 trades pay off. Cash avoids the forced selling. Gold protects against the Fed's money printing. Volatility bets soar as panic spreads. Then comes the move almost no one is prepared for. The 4th trade. Buying at max fear. Every investor who successfully performs the three trades follows with one final step. They buy the bottom. It's what Kennedy did after 1929. What Buffett did in 2008. What Ackman did in 2020. The bottom likely arrives in mid-late 2026, when fear peaks and liquidity floods the system. That's when you buy strong companies, distressed real estate, beaten-down assets that will recover. Buy during maximum panic, then hold for years. That's how long-term generational wealth is created. How normal investors can do a simple version. You can't trade exactly like Burry or Paulson, but you can follow a simplified model. 1. Raise some cash. Reduce stock exposure and build liquidity. 2. Hold some gold. 5 to 10% of your portfolio. 3. Buy basic protection. SPY puts 6 to 12 months out. Small cost, big payoff in a crash. These 3 moves protect you now and position you for the opportunity later. The final choice, smart money, has already acted. The signals are visible. The pattern is repeating. But the trades must be executed before the crash, not during it. Most people will ignore the pattern and lose half their wealth. A small number will recognize it early and come out wealthier than ever. Which side you fall on depends on whether you act now or wait until it's too late. This isn't financial advice. It is recognizing a cycle that is repeated for a century